On the morning of the 26th of March, 2021, a prime broker issued an event of default notice. Within days, a single-family office collapse helped push global bank losses beyond $10 billion. And the part that should scare you is this: the exposure was opaque across brokers. It was built through swaps into roughly $160 billion of stock exposure. Punchline: if the downside can't be named, it owns you. This is checklist library number 2. Downside first. Archegos. No stock picks. No prediction. Just decision training. How to avoid ruin before you chase returns. A prime broker is the part of a bank that gives large clients financing and trading access. A margin call is a demand to post more collateral when losses grow. And swaps can make exposure look like it's not in your name while the risk still sits on you. Archegos didn't fail because markets are evil. It failed because leverage turns a normal drawdown into a forced liquidation. So your job isn't to find the best trade. Your job is to survive the worst day. Downside first is one simple algorithm. Bound the downside in a single number. Identify anything that can force you to sell. Verify you can exit before the exit is urgent. Now we earn that algorithm with one case, Archegos, because it's the cleanest example of how not seeing the full downside becomes a wipeout. Archegos was a family office, not a household name, but it built massive positions through total return swaps across multiple prime brokers. That detail matters. When exposure is split across brokers, no single broker sees the whole picture. Each one sees a slice. The total exposure becomes hard to see from the outside and dangerously easy to underestimate from the inside. Now the chain. During the week of the 22nd of March, 2021, the value of Archegos positions fell. As prices dropped, prime brokers issued margin calls. Here's the mechanical truth. A margin call is not an opinion, it's a deadline. When you can meet it, you keep control. When you can't, you lose control. Fast. Archegos tried to stop the bleeding by asking prime brokers for a standstill, a pause while it liquidated position. The brokers declined. Then, on the morning of the 26th of March, a prime broker issued an event of default notice and began unwinding position. This is the moment most retail investors never model. They think the risk is the price moves against me, but the real risk, the ruin risk, is I get forced out at the worst possible time. Forced selling is not just selling. Forced selling is selling without choice, without time, and often without good prices. And when multiple brokers unwind at the same time, you get a feedback loop. Prices fall. Margin calls grow. Liquidity disappears. More selling hits the market. Prices fall again. That is how normal volatility becomes a collapse. So the core lesson of Archegos is not stocks are dangerous. The lesson is leverage plus opacity equals forced liquidation. And this is why downside first is not a vibe. It's a survival algorithm. Now, I'm going to give you checklist library number 2 in 3 hardness levels. Not as a list of warnings, as a single process you can run on any asset, stock, crypto, real estate, private deals, even business decision. Level 1 is the 10-second circuit breaker. If any rule hits, you pass. No debate. 10-second circuit breaker. Hit 1. Pass rule 1. No max. Rule 2. Any path to forced liquidation. Pass rule 3. Leverage is required for the trade to work. Pass memory line. If I can't bound the downside, I'm not in control. Level 2 is the 30-second entry filter. You don't think these. you write them. If you won't write them, you're not ready. 30 second entry filter, write it down or don't do it. Rule 1, write your max loss in dollars. If it changes your sleep, no position. Rule 2, write the exit trigger first. No exit, no entry. Rule 3, name the forced sell trigger, margin, loans, counterparties. If any can force you out, size down or pass. Ruin is a process problem, not a market problem. Level 3 is the 2-minute deep check for serious size. This is where Archegos becomes a training simulator, because the fatal mistake wasn't wrong direction, it was wrong structure. 2-minute deep check for serious size. Rule 1, forced sell map. Ask, what can force liquidation, margin terms, financing, counterparties, contract triggers? If liquidation can be forced, your downside is larger than your model. Rule 2, exit reality check. Ask, can I exit without moving the price? If not, assume worse fill. Rule 3, concentration and correlation check. Ask, if my positions move together, do I fail? If you're not diversified, you're concentrated in disguise. Closing line for the checklist. You don't need the best trade. You need the trade you can survive. Now, I want you to notice something. None of these rules require predicting prices. None of them require being right about the market. They only require being honest about structure. Can I define my max loss? Can I avoid forced selling? Can I exit in time? That is the difference between an investor and a victim of mechanics. And this is why the swaps detail matters. Swaps don't just create exposure. They create opacity across brokers, and opacity makes it easier to underestimate total downside. When your exposure is opaque, you can't reliably answer the only question that matters. What breaks if I'm wrong? Boundary matters. Downside first is not enough when verification is impossible. Opaque private deals, complex derivatives. You don't understand, or any structure where you cannot map forced liquidation. In those cases, the correct action is simple. Past not financial advice. Decision training. If you want to practice, comment with a single max loss in dollars. Exit trigger. Forced sell trigger. If you can't write those 3 lines, the checklist already gave you the answer. Next episode, well run, checklist library number 3, incentives and map, who gets paid, who verifies, and who suffers if you're wrong.